Welcome back to Build Wealth Now News, everyone. I'm your host, Billy Bob, and joining me as always is our brilliant co-host and market analyst, Sarah. Today, we are diving deep into a name that is in all of our pockets, laptops, and offices. Microsoft Corporation, ticker symbol MSFT. Now, the stock has taken a bit of a tumble from its highs, and investors are asking, is this a once-in-a-decade buying opportunity, or is the AI party finally over? Sarah, let's break this down step by step, starting with the basics. What exactly is the business we're looking at here?
Thanks, Billy Bob. Let's start with Section 1, the business. Microsoft is no longer just the Windows and Office company. Today, it's a three-pillar powerhouse. First, productivity and business processes, about 43% of revenue, which is your Microsoft 365 and LinkedIn. Second, intelligent cloud. 38% of revenue, dominated by Azure, which is their cloud computing and AI infrastructure backbone. And third, more personal computing, 19% of revenue, which includes Windows, devices, and gaming, especially after the Activision Blizzard acquisition.
I love that. Peter Lynch always said, invest in what you know. Every single one of our viewers has used Word, Excel, or Teams. It's a ubiquitous, understandable business. But let's move to Section 2, business phase analysis. Where does Microsoft sit in its corporate life cycle?
According to our integrated research engine, Microsoft is firmly in Phase 5, capital return. The decision tree is clear. They have massive positive operating income, $128.5 billion, growing revenue around 15% year over year, and they are aggressively returning capital to shareholders via dividends and a $60 billion share repurchase program. However, Billy Bob, what makes MSFT unique is that it's a Phase 5 company that still has Phase 2 hyper-growth characteristics in its Azure and AI segments.
That's the holy grail, right? Warren Buffett loves a mature company that throws off massive free cash flow, buys back its own stock, and still has a growth runway. Speaking of which, Section 3, moat analysis. How wide is Microsoft's moat, and is it holding up?
It is a wide moat, and it is actively widening. The two primary sources are switching costs and intangible assets. For switching costs, once an enterprise migrates its data, workflows, and identity management to Azure and Microsoft 365, the friction to leave is astronomical. We see this in their 6% commercial seat growth and high retention. For intangible assets, their brand trust and massive AI patent portfolio give them incredible pricing power. Morningstar agrees, rating it a wide moat, and our first principles analysis confirms that AI integration, like Copilot, is actually deepening this moat, not diluting it.
Buffett calls that a toll bridge. You have to pay to cross, and there's no viable alternative route. Now, let's talk about the future. Section 4, growth driver analysis. Where is the next dollar of revenue coming from?
Our 2x4 framework shows a balanced growth strategy, but the absolute strongest drivers are in existing customer expansion. Specifically, pricing power. They recently raised prices on Microsoft 365, and revenue per user grew despite stable seat counts. That's textbook pricing power. New products/services, Microsoft 365 Copilot and Azure AI services are driving massive attach rates. Customer retention, net retention remains incredibly high. While they do acquire companies like Activision and expand geographically, the real engine is getting their existing billions of users to spend more on AI add-ons.
That's the Peter Lynch boring but brilliant growth. You don't need to find new customers if you can just sell a $30 per month AI upgrade to the million customers you already have. Let's look at the scoreboard. Section 5, business key financial metrics. Give us the numbers that matter.
The numbers are pristine. Looking at their Phase 5 scorecard, net profit margin, an elite 39.34%, more than double the software industry average of 18.50%. Return on equity, ROE, 31.94%, showing incredible efficiency with shareholder capital. Debt to capital, a remarkably conservative 7.05%. Forward EPS growth projected at 26.98% for the current fiscal year. This is a fortress balance sheet funding a massive growth engine.
A 39% net margin with virtually no debt? That's the kind of financial health that lets a company sleep well at night. But no company is without risks. What should keep investors up at night? What are the risks?
We rate the overall execution risk as medium, yellow. There are three main headwinds: the AI capex versus monetization gap. Microsoft is projected to spend up to $190 billion on AI infrastructure. If Copilot adoption lags, currently reported around 3% to 15% of seats, depending on the metric, that's a massive drag on free cash flow. Regulatory scrutiny. The UK's CMA is investigating whether Copilot bundling is anti-competitive, and there's a securities class action lawsuit alleging misleading statements about Azure growth constraints. Insider selling. Simply Wall Street flags significant insider selling over the past 3 months, which always warrants a cautious eye.
Great catch. Lynch always warned about insiders selling, though he noted they sell for many reasons, but they only buy for one. Let's pivot to Section 7, Valuation Metrics Analysis. Is the stock cheap, expensive, or fairly priced?
Because it's a Phase 5 company, we focus on trailing price to earnings, PE, and price to free cash flow, PFCF, while ignoring high growth multiples like price to sales. Right now, MSFT trades at a forward PE of 20.39 times. For a company with a 39% net margin and 27% expected EPS growth, that is actually at a multi-year low for Microsoft. The market has compressed the multiple due to the AI spending fears, creating a rare valuation pocket.
So the market is punishing the stock for spending money to grow, even though the underlying business is printing cash. That brings us perfectly to Section 8, Price and Sentiment Analysis. Sarah, put on your CMT, Chartered Market Technician hat. What are the charts in the crowd telling us?
From a CMT perspective, the price action tells a story of transition. MSFT hit a 52-week high of $555.45 and has pulled back to around $390.54, down roughly 18 to 23% year to date. It is currently consolidating. Trend, it's testing its longer-term moving averages. We are watching the 200-day MA closely for support. Sentiment. The mood has shifted from unbridled AI euphoria to a show-me-the-money reality check. Analyst sentiment remains bullish, high confidence, but investor sentiment is neutral, medium confidence, as they wait for the next earnings report to prove AI monetization. Technicals. We are seeing a basing pattern form. A CMT would look for a high-volume breakout above the recent consolidation zone, or a bounce off established support levels around the $370 to $380 area before aggressively adding to a position.
Excellent. So the technicals say be patient, wait for the base to build or the breakout to confirm. Finally, Section 9, Analyst Price Target and Discounted Cash Flow, DCF. What's the mathematical fair value?
The DCF models from Simply Wall Street place Microsoft's intrinsic fair value between $543.21 and $567.87. At the current price of approximately $390.54, the stock is trading at a 30% to 41% discount to its intrinsic value. The Zacks consensus is a hold, rank 3. Largely because the street wants to see the Q4 FY 2026 earnings on July 29th to confirm that the massive capital expenditures are actually translating into Azure acceleration and Copilot revenue.
Let's bring it all together for our viewers. If I'm a Warren Buffett or Peter Lynch disciple, how do I view this?
The Buffett/Lynch perspective. Buffett would love the wide moat, the 31% ROE, the low debt, and the capital returns. It's a wonderful company. Lynch would point out that at a forward PE of 20 times with 27% earnings growth, the PEG ratio is actually quite attractive, under 1.0. The business is simple to understand, and the AI narrative, while hyped, is backed by real existing enterprise customers. The only Lynchian warning is to ensure the story of AI doesn't outpace the actual numbers on the income statement.
And the CMT perspective?
The CMT perspective says the fundamentals are great, but the trend is currently paused. Don't catch a falling knife. Look for price to respect support, watch for declining volume on down days, and wait for a confirmed reversal pattern or a break above the 50-day moving average before committing heavy new capital.
So what is the final verdict for our viewers? Buy, sell, hold, or do nothing?
Our official rating is hold/accumulate on weakness. If you already own it, do nothing/hold. The fundamentals are intact, and selling a wide moat compounder during a multiple compression is a classic retail mistake. If you are looking to buy, accumulate on weakness. Use the current consolidation to scale in. Don't go all in at once. Set limit orders near technical support levels, $370 to $380, and let the upcoming earnings report be your catalyst for the next leg up. The 30 to 40% DCF discount provides a massive margin of safety for long-term investors.
There you have it, folks. Microsoft, a fortress business, temporarily on sale because the market is impatient. But as we always say on Build Wealth Now News, patience is the ultimate arbitrage. Sarah, thank you for that masterclass in fundamental and technical analysis.
My pleasure, Billy Bob.
If you found this breakdown valuable, smash that like button, subscribe to the channel, and drop a comment below. Are you buying the AI dip or sitting on your hands? We'll see you in the next broadcast. Build your wealth, and we'll see you next time. Build Wealth Now News is dedicated to research the businesses behind the stock names. Our research are done with artificial intelligence assistance using the best practices in the industry. Please note that investing carries its own risk, and you should do your own research before committing any stock to your own portfolio. This conversation is for educational and entertainment purposes only.